Your portfolio does not need 27 funds. It needs consistency. This simple truth is where we begin our journey today. Many people believe that successful investing must be complicated. It requires a constant search for the next big winner, or a portfolio filled with dozens of different holdings. This complexity often leads to confusion. It leads to high fees, and it creates emotional decision-making at the worst times. The reality is, a straightforward, disciplined approach can often yield better results. A simple plan, followed with unwavering consistency, lays the foundation for lasting wealth. It's a promise of clarity in an overwhelmingly complex world. The idea is to remove the noise. When your strategy is simple, you're less likely to second-guess during market turbulence. You're less likely to chase fleeting trends or react to alarming headlines. Instead, your focus shifts from trying to outsmart the market to simply participating in its long-term growth. This isn't about a secret formula. It's about harnessing broad market exposure, low costs, and the force of compound growth over many years. Let us take a moment to understand the foundation of our simple portfolio, the index fund. Imagine the entire U.S. stock market as a very large basket filled with thousands of different stocks from many different companies. Instead of trying to pick out the few individual stocks you think will perform the best, which is a very difficult and risky task, an index fund offers a much simpler solution. It is designed to buy a little piece of every single stock in that big basket. By owning an index fund, you are not betting on one company. You are investing in the overall growth and success of the entire market. It is a way to own the haystack, rather than searching for the needle. The fund is not managed by someone actively trying to pick winners and losers. Instead, it passively follows a preset list, or an index, like the S&P 500 or the total U.S. stock market. Because the fund is not paying a team of analysts to do extensive research and make constant trades, the operating costs are typically very, very low. Every dollar you do not pay in fees is a dollar that stays invested in your account, working and compounding for you over time, which can make a significant difference in your final outcome. When you buy a single share of a total market index fund, you are immediately spreading your investment across thousands of companies in hundreds of different industries. This diversification helps to reduce your risk. If one company or even one entire sector has a bad year, its poor performance is buffered by the thousands of other companies in your portfolio that may be doing well. For most people, the slow and steady journey on the big ship is a much more reliable way to reach their destination. Now, let us explore 3 simple baskets or conceptual portfolios built using low-cost index funds. These are not recommendations but educational examples to show how simple a portfolio can be. The first we will call Basket A. This is the ultimate in simplicity. It is a one-fund portfolio. This basket would hold 100% of its assets in a single fund, such as a total U.S. market index fund. This one fund gives you ownership in large companies, medium companies, small companies across the entire United States. It is incredibly easy to set up and even easier to maintain. Next, we have Basket B. This basket uses 2 funds to replicate the total market. For example, you might allocate 80% to an S&P 500 index fund and 20% to an extended market index fund. This achieves broad diversification like Basket A, with a clearer view of large cap and small cap segments. Finally, there is Basket C. A common allocation would be 80% in a total U.S. market index fund and 20% in a total international stock market index fund. This gives you exposure to thousands of companies in developed markets and emerging markets. Whichever conceptual basket you consider, the key principle remains the same. Keep it simple. The exact percentages are less important than your commitment to the plan. Whether you choose a 1-fund, 2-fund, or 3-fund solution, the goal is a structure you understand, are comfortable with, and can contribute to consistently for many years. To truly understand the power of this simple approach, it helps to see it. For Basket A, single solid color, 100% total market. For Basket B, 80% S&P 500. For Basket B, 20% extended market. For Basket C, 80% U.S. market. For basket C, 20% international holdings. These charts show at a glance how simple your allocation can be. Imagine a simple, consistent contribution, just $35 every single week. The line starts at 0, then begins to climb. At first, growth is slow. Over years, compounding takes hold. The line curves upward, steeper and steeper. Finally, a bar chart showing milestones. Each bar, a decade of consistent saving. After 10 years, $27,700. After 20 years, $89,300. By 30 years, $226,000. Pie chart, BART simplicity. Line chart, BART compounding. Bar chart, BART concrete milestones. Together, they form a roadmap. Patience and discipline make financial security possible and simple. Let us talk about something that may seem small but has an enormous impact on your long-term success. Fees. Every fund you invest in charges a fee, known as an expense ratio. It might be a tiny number, like 0.02%, or a larger one, like 0.8%. While the difference may seem insignificant day to day, over a lifetime it can grow into a very large sum. Imagine two investors earning the exact same 8% return before fees. One pays 0.02%. The other pays 0.8%. At first, the difference is barely noticeable. Fees are like a small leak in a very large ship. Over time, a gap begins to form. Decades later, that once small gap becomes a chasm, potentially tens or hundreds of thousands of dollars. This is why choosing low-cost funds is a cornerstone of long-term success. You cannot control the market tomorrow, next month, or next year, but you can control fees. By choosing funds with the lowest possible expense ratios, like many index funds offered by providers like Fidelity, more of your money stays working for you. It is a simple decision that pays enormous dividends over the long run. Let us bring this all together with a simple, concrete example. Imagine you decide to start today. You choose the simplest path, Basket A, with 100% in a total U.S. market index fund. You commit to just $35 each week. That is $5 a day. You set up an automatic transfer so you never forget. This single action is perhaps the most important step you will take. For the first few years, not much seems to happen. There will be good months and bad months. The key is to ignore the noise and trust the process. This is called dollar cost averaging. When the market is down, your fixed $35 buys more shares. When up, it buys fewer. 10 years pass. Assuming an 8% average return, you see a balance of over $27,000 on roughly $18,000 contributed. The rest is growth. 20 years, approaching $90,000 on about $36,000 contributed. 30 years, about $226,000 on about $54,600 contributed. This is the payoff, the reward for consistency, patience, and discipline. You do not need a large income or a complex strategy to build significant wealth. The numbers we have discussed are more than just data points. They are milestones on a long and rewarding journey. After 10 years, $27,700, the foundation you have built, proof your plan is working. 20 years, $89,300, compounding becoming more visible. 30 years, $226,000, a life-changing amount for many. Looking further, at 40 years, $529,000. At 50 years, over $1.2 million. Around $1.2 million, monthly growth and income can cover living expenses. These milestones aren't guarantees, but they illustrate what's possible with a simple plan and the two most powerful forces in investing, time and consistency. They help you keep your eyes on the prize when the market feels uncertain. Once you have built your simple basket, the work is not entirely over, but it does become much, much easier. One of the most important checkups is rebalancing, bringing your portfolio back to its original target allocation. If your 80-20 US international split drifts to 85-15, you sell a little US and buy more international to get back to target. This enforces buy low and sell high. It helps prevent becoming too heavily weighted in one area. For most people, once a year is more than enough. Another critical part of staying on track is to resist the urge to tinker. Your simple portfolio is designed to be boring. Every change can add fees, taxes, or trigger emotional mistakes. Sticking to your boring plan is your superpower. Finally, remember that all investing involves risk. Values go up and down. This is normal. A 20% drop feels terrifying over 6 months. Over 30 years, it is a bump in a long, rising road. Stay calm, stick to your plan, and continue your regular contributions. This is how you keep your simple plan working for you, year after year. We have covered a lot of ground today, but the central message is beautifully simple. Building wealth does not require a secret formula, a high-risk strategy, or a portfolio with dozens of complicated funds. It does not demand that you spend hours watching financial news or try to predict the market's next move. History has shown such efforts are often counterproductive. Simple wins. Boring gets rich. You begin by choosing a simple basket, like one of the 3 we have discussed, built with low-cost, broad market index funds. You automate your savings. Every week, every month, no matter what. You mind fees and give your investments time. Once a year, you check and rebalance if needed. Your portfolio does not need 27 funds. It needs consistency. Pick your simple basket. Start contributing today, even if it is just a small amount. Trust in the process. Be patient through the ups and downs. Start now.